Hello students, in this video we are going to discuss about profitability ratios. Profitability, it is a combination of two words, profit plus ability. These ratios are used to check the profitability of the company. These ratios are used for inter-firm comparison and intra-firm comparison also. These ratio tells us how efficiently our company is working. To check the overall efficiency of the company, we use profitability ratios. These all ratio depends on income statement. Let us understand. Number one, gross profit ratio. First one is gross profit ratio. The formula is gross profit divided by net revenue into 100. So gross profit divided by net revenue into 100. This ratio, if it is high, then that means company is able to pay its operating and non-operating expenses very easily. So higher is good. Now how to calculate gross profit? The formula of gross profit is revenue minus cost. Revenue minus cost. What is the formula of cost? How cost is calculated? Opening stock plus purchases plus direct expenses minus closing stock. So revenue minus cost is equal to gross profit. And net revenue means total revenue minus revenue return. Next ratio is operating profit ratio. Operating profit ratio. The formula of operating profit ratio is operating profit divided by net revenue into 100. Now, how to calculate operating profit? There are two methods for the calculation of operating profit. Number one, direct method. Number two, indirect method. How to use direct method? When gross profit is given, less operating expenses plus operating income is equal to operating profit. Operating expenses, there are two operating expenses mainly: office and administration expenses, selling and distribution expenses. Examples of operating income: royalty received, commission received, bad debts recovered, these are some examples of operating income. So formula of operating profit is gross profit minus operating expenses plus operating income. Indirect formula, suppose net profit is given in the question plus non-operating expenses minus non-operating income. Examples of non-profit expenses: interest paid on long-term liabilities, interest paid on long-term liabilities, loss on sale of fixed assets, that means abnormal losses or written offs. Preliminary expenses written off, share issue expenses written off, or written offs. These are some examples of non-operating expenses. Non-operating income. Examples: rent received, interest received, dividend received, profit on sale of fixed assets are some examples of non-operating income. So what is the formula of operating profit ratio? Operating profit divided by net revenue into 100. Next, net profit ratio. Net profit divided by net revenue into 100. Net profit means gross profit minus indirect expenses, operating and non-operating, plus incomes, operating or non-operating. Net profit. You can take net profit before tax or net profit after tax. Fourth point, operating ratio. When we are talking about operating ratio, that means operating cost ratio. Operating cost ratio. The formula of operating cost ratio is cost of revenue plus operating expenses minus operating income, if any, divided by net revenue into 100. Cost of revenue plus operating expenses. Cost of revenue, here we have calculated opening stock plus purchase plus direct minus closing stock. First of all, we will have to calculate cost of revenue, then plus operating expenses. Two operating expenses are there: office and administration, selling and distribution, minus operating income, royalty received, commission received, bad debts recovered. So this is called operating cost divided by net revenue into 100. Lower the ratio is good. Next, ROI, return on investment, also known as return on capital employed. The formula: profit before interest and tax divided by capital employed. Capital employed into 100. Suppose profit after interest and tax is given in the question. After interest and tax is given. First of all, tax will be added back. Then profit before tax will come, and then interest paid on long-term liabilities will be added back. Then only we will be able to calculate profit before interest and tax. Divide by capital employed. How to calculate capital employed? There are two approaches for the calculation of capital employed. Number one, assets approach. If we are using asset approach, total assets minus current liabilities, first formula. And if we are taking liability approach, first heading of liability side, shareholder funds, and second, non-current liabilities. So these two approaches are used to calculate capital employed. The formula of return on investment, once again, profit before interest and tax divided by capital employed into 100. So these 5 formulas are there, 5 ratios are there, which are used to check the profitability of a company. Thank you.